So, welcome to another session of FMP. So, in this session we will talk about introduction to derivatives. The main agenda of this chapter is to clear the basics around what derivatives is and what are the different products which we are going to study in derivatives. So, as you can see, a derivative is nothing but a financial instrument which derives value from some underlying asset. So, in a very nutshell, a derivative is a financial instrument which derives its value from some underlying variable. Now, in case of financial instruments, a derivative is mostly a financial product wherein there has to be an underlying asset. Now, that underlying asset can be equity, it can be a commodity, it can be a fixed income, and it can also be an interest rate. So, if your underlying asset is, let us say, equity, then the derivative could be, let us say, equity futures, it could be equity forwards. So, in a very basic layman terminology, you can think about, let us say, milk as an underlying asset and its derivative could be paneer or ghee or curd. So, anything which derives value from an underlying asset is derivative. Now, as I said, very often the variable underlying derivatives are prices of tradable assets. As I said, it is the tradable assets could be your stock, it could be commodity, it could be a fixed income, it could be interest rates. The examples are stock futures, interest rate futures, stock forwards, options, bonds, swaps, and there are a lot of other derivative products, but from FRM's perspective, these are the 5 or 6 different derivative products which we are going to talk about. So, essentially your derivatives would be covering mostly your options, it would be futures, it would be forwards and swaps. And one more thing which we will be covering in this particular derivatives would be your fixed income derivatives. So, now coming back to derivatives, where are these products actually traded in the market? So, there are majorly two areas where a typical derivatives would be traded. One is OTC, which is your over the counter, and the other is exchange. So, OTC is nothing but over the counter markets and exchange is a typical, let us say, a big player, you can say, let us say an exchange like NSE or BSE. So, OTC is mostly like, it's like you call your dealer and you say, okay, I want to buy a certain product, and it's a bipartite transaction wherein you know whom you are dealing with. Essentially, you know your dealer, you know the counterparty with whom you are trading. So, trades are mostly done over telephone and it is between two financial institutions, generally between an FI on one side and clients on the other side. For example, let us say Microsoft wants to enter into a futures contract. So, it might call up JP Morgan that it wants to get into a big forward contract, not futures, it is a forward contract. So, a forward contract is typically a OTC product wherein you know whom you are connecting with, you know whom you are trading with. FI acts as a market maker. So, market maker essentially means it is not just Microsoft who is calling let us say JP Morgan, right. There could be a lot of other players who would be dealing with this typical FI. So, FI is essentially a market maker wherein it connects the different buyers and sellers in the market. So, let us say if Microsoft wants to buy interest rate swaps and Intel wants to enter into a counterparty agreement, then JP Morgan would act as an intermediary to both Microsoft as well as Intel. So, on one side you will have Microsoft, on the other side you will have Intel. Now, Microsoft and Intel might not know each other, but yes, Microsoft and Intel would know whom they are dealing with, which is JP Morgan or let us say any other FI. So, this means that there is always a bid price and an offer price. So, now let us understand what a bid and an offer price is, because it is very important to understand how a typical products are getting traded in the market. So a bid price and ask price is a very basic concept when you will talk about this in almost all the asset classes which are getting traded, not just derivatives, but also in case of equity, in case of any other products. So when we talk about bid and ask, to begin with, let's say I want to buy gold. So for gold, I am going to essentially go to a particular jeweler and I will ask what is the buying price and what is the selling price. So let's say you go to Kalyan Jewelers and Kalyan Jewelers says, okay, we are going to buy gold at 1 lakh and we are going to sell gold at 1 lakh 1000. So the bid price and the ask price is from a typical market maker's perspective. So market maker would tell what is his buying price, which becomes the bid price, and what is his selling price, which becomes the ask price. So let's say Kalyan Jewellers says that they are going to buy gold at 100,000 and they are going to sell gold at 101,000, which means if I want to buy gold, then 101,000 I will have to pay to Kalyan Jewellers, and if I want to sell gold, then 100,000 is what I will be receiving by selling gold. So it's just not me who is trading with Kalyan Jewellers. There might be a lot of other people who might be trading with Kalyan Jewellers, right? So they will provide what is their requirement, whether they want to buy or sell. So Kalyan Jewellers acts as a market maker, which basically means it buys gold, it sells gold, it helps in facilitating these particular transactions. Now, when we talk about bid and ask, one thing which we always keep in mind is what is the difference between the bid and the ask. The reason it's very important is if the difference between bid and ask is very high, it essentially means that the liquidity in the market is very low. Just think about a case wherein, let's say, your bid becomes 75,000 and your ask remains 101,000. This essentially means that if you want to buy gold, you have to pay 101,000 to Kalyan Jewellers, but if you want to immediately sell the same thing, you will get only 75,000. So essentially it's a 26,000 loss. So the more the difference, the lesser would be people's intention to trade. The reason being, they would not want a scenario where the buyers and the selling price is way too high. So as I said, the main purpose of bid ask is to ensure that there is liquidity in the market, and if there is liquidity, if there is more demand and supply, then this difference would essentially be reduced, and the lesser the difference, more is the liquidity in that particular script or in that particular tradable asset. So coming back to this particular point, that this means that these market makers are always prepared to quote both bid side and ask side. Offer price is also called ask side, ask price. So if you talk about OTC and exchange, as you can see here, OTC is a very fragmented marketplace, which means every player would have a counterparty. So let's say this is the one which is in grayish sign is your market maker, and each market maker would be connected with various buyers and sellers in that particular market. So in case of exchange, there is a centralized marketplace, which means there is only one exchange and everyone is dealing with that particular exchange only. So in case of OTC market, the marketplace is highly fragmented, which means there are a lot of players who can act as a market maker, but in case of exchange, exchange is the one which acts as a market maker. Now if you look at this particular slide, and if I ask you what is this blue color graph and what is this red color graph, the graph talks about volumes traded on these two particular marketplaces. The blue one is your OTC derivatives and the red one is your exchange. So as you can see here, the volume traded on OTC market has been exponentially rising, whereas the volume traded on a typical exchange on an average is kind of flattish. And the prime reason for that is, in case of your OTC markets, there are a lot of customizable products which can get traded, which is not possible in case of exchange. A typical example could be, let's say, swap, right? And you want to customize your swap agreement, so you have to anyway go to your OTC markets. In exchange, everything is standardized. Exotic options, for example, right? These are very customizable product which cannot be traded on a typical exchange. So that's the prime reason why we will see that the volume on a typical OTC market is very high. So let's begin with a forward contract. So we'll be talking about what a forward contract is. A forward contract is nothing but it's an agreement to buy or sell an underlying asset at a fixed price at a future date. So there are a couple of things which you need to keep in mind here. First is, it is an agreement to buy or sell an underlying asset at a certain date which has to be in future and at a certain price. So in case of a forward contract, it's an OTC product. So when I talk about OTC product, it is over the counter, which means it is traded between two people, wherein one is a buyer and another is a seller, and the price is fixed as of today's date, and it is fixed at a certain price. So just to give an example, let's say if we again go back to the Kalyan Jewellers numbers. So let's say if I want to buy gold, right, as of today, I can buy or sell at these particular rates, right. I will just rub this one because this is an example. Now let's say, okay, this is my spot market, and let's say I have a forward market. Now what is a forward market? A forward market is a market for delivery of underlying asset at a future date. So let's say today is 16th of June and you want to buy gold today. So you will go to Kalyan Jewellers and you will buy it at 101,000. But let's say my requirement is I don't want to buy gold today, but I want to buy gold, let's say 3 months down the line, wherein I have a occasion, right. So let's say I want to buy gold on 26th of let's say September. Now if I want to buy gold at a future date, Kalyan Jewellers will not give me this quote because this is the quote as of today. 3 months, 4 months down the line, if I want to buy the gold and I want to fix the price today, then the Kalyan Jewellers as a market maker would need to make the adjustment to the price because there is a 3 months delay in the delivery of underlying asset. So there is a risk and the price would be reflective of that particular risk. So the price which Kalyan Jewellers will quote would eventually be more than the spot price. In almost all the cases, there are few exceptions which we are going to talk about later, but in general, because future is uncertain, the price for a future delivery should reflect that particular risk. So let's assume Kalyan Jewellers gives a quote of 106,000 and 108,000. So what this particular information means here is, if you want to fix gold's price 3 months or 4 months down the line, which is let's say 26th of September, you can fix it at 108,000. So does it mean that I have to pay 108,000 today and then get gold after 3 months? No. It's a contract between two parties, which means that it's a verbal contract. So you fix this contract at 108,000, and that would mean that once you want to settle it on 26th of September, then you will pay 108,000 and get 10 grams of gold, right. So this 108,000 would be settled against the spot price of 26th of September. So, this 26th of September spot price we do not know, right. So, as of today all we know is what would be the forward price as of 16th of June, right, and the forward date is 26th of September. So, one thing which people confuse here is 26th of September, what does it actually mean? This means that if you want to fix the gold price today, but the delivery will be on 26th of September, right, and this price will keep on changing. So, tomorrow you might see a different quotation, but the delivery date would remain the same. So, this is 16th June forward price, right, and if I want to let us say I do not want to get into forward contract today, let us say I want to wait till tomorrow. So, I will get a separate, so 17th June I might have a new forward quotation, which could be let us say 106.5 thousand and 109,000. That depends upon a lot of market dynamics, right. But then remember this, that every day or maybe every moment this quotation will keep on changing, right. But this quotation is for 26th of September delivery. So, if you want to get into the 26th September delivery on 16th of June, then you need to fix it at 108K, but if you want to do it tomorrow, which is let us say 17th of June, then it would be at 109K. Okay. Now, let us assume that you decide that fine, I would want to enter into the forward contract today itself, which is 16th of June, and I want to fix the price at 108,000. Fine. So, you get into this contract with Kalyan Jewellers. Now, what happens is on 26th of September, there would be a spot price, because spot price also will keep on changing every moment. So, on 26th of September there would be a spot price, right, and let us assume that spot price is 120,000 and 121,000, which means now on 26th of September you can sell gold in the spot market at 120,000, but you fix the price at 108,000, which means you will go to Kalyan Jewellers and say, please take 108,000 and give me 10 grams of gold, which you can sell in the market at 120,000, right. So, it is this immediate profit of 12,000 which you can get, because the spot price on 26th of September has gone above the price which you had fixed with Kalyan Jewellers. So, essentially if I draw this, this is you, this is Kalyan Jewellers. So, on 26th of September, it is like you pay 108,000, you get 10 grams of gold, which you can sell in the current market as of 26th of September for 120K. Now, although this looks good from understanding perspective, but in real life what happens is, it is not that you will pay 108, you will get 10 grams of gold and you will again sell it in the market. So, this transaction is netted off, which means effectively it is like you are paying Kalyan Jewellers 108 and you are getting 120. So, Kalyan Jewellers will say, or the principles of forwards is such that one party would pay the difference and one party would accept the difference. So, essentially in this case, this is you, and this is Kalyan Jewellers. So, because the price differential has been in your favor, you will receive 12,000. Now, you might ask, what if the market goes other way around, which is, let's say, what will happen if the price instead of 120k, what if it falls to 100,000, which is 1 lakh. So, in this case, again the difference is 8,000, which is against you. So, you will be paying Kalyan Jewellers 8,000. If spot on 26th September becomes 100,000. So, the spot on 26th of September becomes 100,000. In that case, you would be liable to pay Kalyan Jewellers 8,000. So, this is a typical nature of forward contract wherein the differential price is settled in that contract. So, let us go back to our understanding of this particular concept. So, as I was saying, forward contract is nothing but it is an OTC product wherein one counterparty buys and another counterparty sells at a fixed date for a fixed date delivery and at a fixed price. So, contrasting this with a spot contract, which is an agreement to buy or sell as of today. So, in a spot market, you are buying the goods for immediate delivery, whereas in case of forward contract, you are trying to fix the price as of future date. So, a forward contract is traded in OTC market as I already discussed, and it is between two financial institutions or between a financial institution on one side and clients on the other side. So, one of the parties to the forward contract assumes a long position. So, long essentially means buy, and he is agreeing to buy the underlying asset on a certain date as specified in the contract and at a specific date in future. So, the price is fixed, the underlying asset is fixed, and the position is also mentioned. So, one of the parties is going to buy the contract at a certain price at a certain future date. The other party would assume that they are going to sell the underlying asset at the same price on a future date. So, one thing is very clear, in this particular contract, if the prices change, then one party would be in profit, another party would be in equivalent loss. So, it is a zero sum game. So, forward contracts are always zero sum game, which means one party's profit is another party's loss. So, this is a typical forward contract. You agree at a certain date, at a certain price, and on that given date, which is in a future date, you settle the contract, and whatever is the differential price, that differential price is being settled. So, forward contract is mostly settled in cash, which is nothing but the difference between the contract price which you have mentioned in forward contract versus the spot price at a future date. So, as I was saying initially, there will always be a bid ask spread. The more the bid and ask difference, the more would be the lesser would be the demand for that particular product, because bid ask essentially means at what price you can buy and at what price you can sell. So, the more differential means lesser liquidity in the market. A typical forward and spot prices would look like something as shown in this particular table. Spot gold, which means the gold in the spot market, what is the current bid and what is the current ask, and then you will have multiple forward contracts. You can trade forward contracts I mean, there is no fixed definition it because it's a customizable product, but generally it is traded 1 month, 3 months, 2 months, 5 months, 6 months depending upon the requirement, and more the future date, the longer the future date, the more would be the forward price. So, as you can see here, 1 month forward contracts has a price which is more than the spot, 3 months has a price which is more than 1 month, 6 months would have a more price than 3 months. Now, what would be a payoff of a forward contract? As I was mentioning initially, it's a zero sum game. So, for a forward contract, whatever is the difference, one party would be paying the difference and another party would be receiving that difference. So, if my contract price, let us assume, is X, let us say, which means this is the price which I have fixed. You can write it as X, you can write it as K, and on 26th of September, which is my future date, the spot price is S. So, one party would receive this difference and another party would be paying this difference. So, if you have bought a forward contract, then your payoff will be S minus X. For example, in our case, the spot on 26th of September, let us say it was 120,000 and we had fixed the price at 108. So, this differential is what I will receive and the seller would pay me this particular difference. Okay? It is a zero cost, basically you do not pay anything for entering into a forward contract, because a forward contract typically has no upfront payment. So, the payoff is decided only at maturity date. It is a linear payoff, which means your profit is the seller's loss and seller's profit is your loss. So, this is a typical payoff. As you can see here, as the spot price goes up, the person who had fixed the contract at X or K, that is my forward price, he will gain. So, for example, if the price, if my contract price was 108K and the spot price goes to 120, then I will be receiving this differential because I had fixed the price at 108K. So, my profit is going to be 12,000, but if it goes down, the same would be my loss, and the opposite would be true for the seller of a forward contract. So, that is why for a person who has long, which means who has bought the forward contract, the payoff is S minus X, which is S minus X, and for the person who has sold the forward contract, it is X minus X. That is the payoff. So, this essentially completes the basics of derivative contract, derivative products. In the next class, we will talk about futures contract. So, we have talked about forwards, the basics of forwards, and in this particular session, we are going to talk about what is futures. See you in the next session. Thank you.